You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the old Options Insider Radio Network, where we tell you, the busy financial advisor, asset manager, fund manager, how you too can incorporate options into your clients' portfolios. We also give you a little bit of an update, keep you apprised of all the goings on in the world of options and derivatives that impact you guys directly. We know you guys are busy. You're out there handling your clients' money, which is your job. So it's our job to keep you informed of the latest developments. So we do that for you, as well as a little bit of education and a whole bunch of other fun stuff, and answer a lot of your questions. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the aforementioned Options Insider Radio Network. If you're just joining us for the first time here for our first program here of 2017, first off, welcome. Secondly, you got a lot to catch up on, so don't be afraid to check out our archives. I know it's a little bit daunting. We have been on the air now for 10 years, which is crazy, hard to believe, but 10 years, including many great years of the Advisor's Option, many great archived episodes, great guests, great interviews, great debates, great discussions. The easiest place to find all that, theoptionsinsider.com. Of course, you can always grab us iTunes, TuneIn, Stitcher, and so on and so forth. You can just subscribe directly to the Advisor's Option if you just want that. And if you want to get the whole fire hose of our network content, it's quite a lot of options content. But if you're up for it, then subscribe to the full network, and we will keep you busy. Trust me. There's daily content for your listening pleasure there on the network. So check that out if you are indeed so inclined. And of course, if you want to find us via the app stores, iOS, Android, and the beloved Fire OS. And joining me on the old program today, we got a duo beaming out of the Swan HQ in Puerto Rico, starting off with our old friend, Mr. Chris Hausman, the portfolio and chief technical strategist over there at Swan Global Investments. Chris, welcome back to the Advisor's Option program.
Hey, Mark. Thanks for having me again.
And also joining him from an adjacent office in the Swan HQ there in scenic and sunny Puerto Rico is Aash Vyas. He is the Director of Portfolio Strategy and Overlays over there at Swan Global Investments. Aash, welcome back to the program, to you as well.
Thanks, Mark. Happy to be here.
got a twofer holding down the Swan hot seat. We split it this episode. And also joining us, a frequent offender here on the old network. You know him from his many appearances on Volatility Views, but he's also the author of the seminal tome, Options for Advisors and Institutions. It is truly, listeners, a mountainous tome. You really need to make sure your desk has the structural support to withstand it. But if you are an advisor, you're interested in options, he has literally written the book for you. Mr. Russell Rhoads, also the head of education over there at the Options Institute of the CBOE. Mr. Rhoads, welcome back to the program, and congratulations again on releasing such a weighty tome of options knowledge.
Stop it. You know better than that. It's not that weighty, but it's a good book.
It's on my desk right now. I use it to bludgeon my recalcitrant staff when they're not ready to do what I need. So it's a useful tome in many regards, sir. I don't know if you published it with that in mind, but it's useful in many different respects. All right, with the team assembled, let's dive right on into The Buzz segment.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody. That music means it's time for The Buzz, the portion of the show where we keep you abreast, keep you apprised of the latest developments in the world of options and how they apply to you, the busy financial advisor and asset manager. And I'd be remiss if I didn't start off the show. It is our first program of 2017. We're not even the first week is complete of a new administration, a new regime here in the U.S. And so a lot of things are different or potentially different on the horizon. It's kind of interesting. We'll get into some of the farther reaching ramifications in a second when it comes to the regulatory front and everything else like that. But we have to start off just kind of maybe giving our 2 cents on just what it's been like for the last few months of the year, of course, leading into the new regime. And now that it's actually happened, we've seen a lot of interesting developments in the market. Of course, the Dow just breaking past 20,000 the day before we record this. We've seen this kind of inexorable rise across most of the indices, I think up 8%, if not more, since the election night. So a strong Trump rally. We've also seen volatility commensurately coming off as a result. There was a little bit of hesitation last week. It seemed like going into the inauguration itself, volatility was creeping back up, maybe a little bit of hesitancy baking into the market. But now that that's behind us, it seems like, at least for the near term, the doubts have been pushed aside. The rally is back in full form, and volatility is once again coming off. So it's an interesting time to be out there trading and managing client money. So let's start with you, Chris. I'm sure it's been an interesting period for you. What's it been like? Give us your thoughts, and just in general, kind of maybe your thoughts and your maybe concerns or interests as we embark on this new regime, and what it's been like, managing money, rolling the protection and things in this period of kind of essentially a near-term aggressive bull market and a bear market in terms of volatility.
Well, you said it right. Near-term aggressive bull market. Usually those are words associated with bear markets. So, I think the big talk has been volatility. We had the uptick right before the elections, and then you had this huge rally. And there was actually I don't know if you were noticing, but, I talk a lot about skew on the program, and what we noticed.
I've never noticed that before, sir. What is this skew?
You never noticed, huh? So, difference between downside strikes and upside strikes. But what actually happened during this rally and going to uncharted territories, if you will, is that there was a lot of people chasing performance on the upside. I know there was a large open interest at the 2,300 strike in the S&P 500. And so there was a lot of call buying, a lot of chasing of upside. And so we actually saw a pretty discernible decrease in skew, meaning upside calls were valued a little bit better than what they historically are to downside puts. Now, that relationship is starting to come back in again over the last few days, where I think just about everybody was prepared for some type of sell-off here, which again, there goes the market, did not materialize, and now we're off to brand new highs. So, we wrapped up our adjusting our portfolios towards year end and over the last couple of months. So, we're in good position right now, volatility-wise, and happy to see what the markets are doing.
Aash, same question for you. You're the guy over there actually overseeing the overlays themselves, which are obviously a big part of what you guys do over there. So what are your thoughts on, kind of been in an interesting couple of months and an interesting couple of days actually here in the markets, and maybe any challenges it's posed for you, and maybe any interesting thoughts you have going forward?
Well, I think we're kind of in a period of regime change with the new administration. I mean, if Donald Trump's a lot of things, but if the leader of the free world is viewed as pure volatility, it should make for an interesting ride.
Yeah, I think we've never really had anything like this before, where we have a president. I remember it seems so long ago now, but of course we had the debate when Obama took the oath of office. Should he be able to use his BlackBerry? Is it even appropriate for the president to have that level of unrestricted access to the outside world? And now we have a president, and Twitter existed back in Obama's first days, but it was nowhere near what it is now. And the notion that we have this president who's literally just unleashing his unfettered thoughts to the world, and we're seeing market impact as a result. It's uncharted territory in pretty much every step of the way. Russell, you guys over there at the CBOE are obviously always watching all things volatility, but it's been an interesting time for a lot of people out there managing money as well, and kind of just navigating these uncharted waters, quite literally. What are your thoughts here as we are embarking on this new regime, both from a volatility and from a political standpoint?
Well, the new regime, I love that. We used to always say volatility regime, and now we're saying Trump regime.
That's why I get the big bucks, sir.
I don't think anybody would have thought that he was going to have a honeymoon period, but I think he's getting it. I even saw some reporters say that he seemed to be doing a much better job communicating with Congress than his predecessor. Can you believe that? And then beyond that, it sounds like Chelsea Manning might like Trump better than the guy that let him out of jail.
You had to go straight to Chelsea Manning, didn't you? But yeah, you're right. No gratitude there for the person who got he or she out of jail. Yeah, interesting stuff. We are in it's also kind of uncharted because the Obama administration leaned heavily on those executive actions /orders /memorandums call them what you will, things that are effective because you don't have to deal with Congress and a lot of that stuff. It kind of just happens. It's nice for an executive branch standpoint, but the downside is if a new administration comes in, they don't agree, they can pretty much wipe the slate clean with a stroke of the pen, and that's pretty much exactly what we're seeing right now. So it's uncharted in a lot of ways for that too, because Trump has the ability to affect a lot of change very quickly, whereas a lot of his predecessors had to really deal. If they wanted to change, they have to go through Congress and do a lot of legislative work, whereas Trump can just sign a document and change a lot of things. So it's unprecedented in many regards, and we're seeing how it plays out in the marketplace right now. At least so far, the markets seem to like it. But of course, one of the things that is a huge question mark on the horizon, and it certainly is a question mark for this audience, the audience of this program here, is what's going to happen on the regulatory front going forward when it comes to all things derivatives in particular. Obviously, our purview on this program. I recently was privileged to chair a panel on this very topic at the Security Traders Association of Chicago event. I believe I have Mr. Rhoads to thank /blame for roping me into the deep end of all things Dodd-Frank. It was an interesting session. You never know at these events if you're going to start talk regulatory reform for an hour if the room's going to clear out, but it actually was well attended, and people stayed throughout the whole thing, which was always very impressive. And there were a couple interesting takeaways that we determined from the great panel that we assembled, and I'd be curious to get your guys' thoughts as well. But obviously, Dodd-Frank has kind of been the law of the land for the past half a decade or so now, and that is all up in the air right now as to what will happen with it. One of the key takeaways from our discussion of this was that effectively it seems like the Choice Act, which has been proposed by a rep out of Texas, it seems like if there is a Dodd-Frank 2.0 blueprint, that appears to be it. So a lot of people are looking to that to see exactly what, even though Trump's rhetoric has been, I'm going to dismantle Dodd-Frank, I'm going to destroy it. His Treasury Secretary nominee says he wants to kill it. All that heated rhetoric aside, it seems like they're really going to amend certain key provisions. One of those key provisions that is clearly on the chopping block is the Volcker Rule. If you're not familiar, listeners, that is, of course, the prohibition essentially that prevents large banks from doing what they they deem speculative investments. What really means is that it kind of bans proprietary trading arms at a lot of these banks. So that's been a very controversial thing, because if you listen to Volatility Views or early episodes of this program as well, you know there's been a lot of debate about whether that has negatively impacted the markets, including the markets that a lot of our listeners here like to trade, like the SPX and some of the larger institutional products, because you remove a lot of liquidity providers, and guess what happens? Liquidity kind of dries up, things get less liquid, things get more volatile as a result. The interesting thing we noted is that under the Choice Act, the removal of the Volcker Rule is put under the section entitled "Helping Small Business," and it kind of struck me as odd that you think you're going to help the mom and pop bodega on the corner by getting rid of reestablishing, I should say, proprietary trading at a large bank. So it is always fun to see how politicians phrase these things. That said, a lot of the big banks have gone through a lot of effort, and this was even mentioned on the panel, effort to really comply with Dodd-Frank, to the point where they may not be willing to go back to adding prop trading arms, which I think may come as a surprise to a lot of people. In fact, just this week, we had the CFO of Citigroup and the CEO of JP Morgan both saying that they will not go back to prop trading if the Volcker Rule is eliminated. I think part of that also is that there's a lot of heat that comes from a PR perspective with these banks getting bailout money, getting federal protection, and then also engaging what some people term or view to be speculative type trading. There's a bit of a PR clash there, and these banks may not want to deal with that hassle. And clearly, two big ones, Citigroup and JP Morgan, both saying they don't want to go back to that. So maybe, even though we've talked about the repeal of the Volcker Rule really changing a lot of things, maybe it won't be the big change agent that we assume. A couple other key takeaways, and I'll get your guys' thoughts. Of course, there's a lot of concern. One of the big initiatives on Dodd-Frank has been migrating liquidity from very opaque OTC markets onto the more transparent listed venues on the exchanges. That's actually been very successful. Some people have been concerned that rolling back Dodd-Frank would indeed roll back those protections, which has been a generally, I think, across the board. Most people, unless you're an OTC trader, most people think it's been a pretty good thing. And it doesn't seem like there's any people who deal with the Congress on a regular basis and the regulators. No one's heard any even whispers that that's going to happen. So that was, I think, reassuring to a lot of the people in attendance, and I'm sure listening here today. The other thing that's really been a key debate on this program, and certainly of interest to this audience in particular, has been the Department of Labor fiduciary rule. We touched on that a little bit in our session, but effectively, if you remember, it was for the better part of a year in this program, we debated whether options would even be allowed in things like IRAs and other retirement accounts, which are, of course, the main use case for a lot of the advisors and asset managers out there when they're coming to use options for their clients. They're writing covered calls and things like IRAs and other retirement accounts. If that was taken away from them, that eliminates the vast majority of the use cases for options for them. So it was a very concerning thing. The industry lobbied hard and aggressively to try to fix that, and it was fixed. But of course, it seems like the fiduciary rule may be back on the chopping block as well, or at the very least be amended. And who knows, that prohibition for options could sneak its way in there again. It's never really been clear to me whether that was a bit of a sin of omission or if someone had an axe to grind against options and left them out as a result. I've heard both sides of that spelled out to me, so it's never really been clear. But that said, so some people are still concerned about that. So all of that a long way around to saying it seems like we have more insight than we thought we did about what may be changed on the horizon, but there still are some concerns. Maybe we'll go back around the horn. Russell, since you wrote me into that panel, we'll start with you. What are your thoughts, and do you have any concerns going forward about how this completely fluid regulatory environment now may impact a lot of the asset managers out there going forward?
I don't see the pendulum swinging farther in a direction that would have a negative impact on asset managers. If anything, I think we're going to get I'm getting ready to use a word with respect to our current president that a lot of people don't use. But I actually think with respect to business, he is somewhat of a reasonable person. And I think I do believe that he sees the need for a reasonable level of regulation. Maybe we've swung a little bit too far toward too much regulation. So I think, if anything, we're going to work our way back toward the middle. I actually went to a presentation about 6 months ago where somebody from the SEC was speaking, and the joke he started off with was, eventually every person in the financial industry will have a personal regulator that goes to work with them, that's the direction we're going. So even those people kind of see that we've gone too much in one extreme. So I'm actually encouraged with respect to, having somebody that's more business friendly in the White House.
That's a bit of a scary notion. You have to carpool with your regulator to work every day. You got room now in your new corner office to have a regulator sitting there all day long, keeping an eye on you. You're joking, but it isn't. We're not that far from that now. We were joking with some people talking about the small banks out there as well, and some small assets under management, 60, 80 million in a bank, and they had been visited by regulators 65 times over the course of the year. So there is maybe a bit of an onerous tinge, shall we say, to the current regulatory environment. Chris and Aash, you guys deal with this on a day-to-day basis, and it's been, I'm sure that's been a question you guys have received a lot as you're doing your Swan conferences and things across the country. What are the what impacts are going to be in terms of the derivatives landscape? Can I continue to use these products? Is the burden going to be onerous? Give us your thoughts on that, what you've encountered talking to other advisors out there, as well as your own personal views and what you've encountered having to trade these things day in and out. What impact has it had, if any, on you guys? Maybe Aash, we'll start with you.
Well, I guess the short answer is follow the money, which may be applicable in a lot of situations. But if this stuff is repealed and there's more liquidity in the marketplace, as the proprietary trading desks backing up the flow desks, well, that's a good thing. But fundamentally, I don't necessarily think the skin in the game equation has changed, and the penalties for being irresponsible aren't really harsh enough. So I commend these banks if they're actually going to follow suit. But if a couple of quarters, a couple of years pass by where they're lagging their competitors, I'm not sure if maybe I'm just a skeptic if that self-imposed proprietary trading ban is going to hold up.
And maybe an addendum question there as well. You guys, and Chris, this is for you as well. You guys are out there every day in big institutional products like SPX and others looking for liquidity. Do you guys, anecdotally, what have your thoughts been maybe pre and post Volcker now that you're out there in a lot of these products? We've heard anecdotally a lot. There's not a lot of hard data, but we've heard anecdotally from a lot of people that it is less liquid, that it is harder to find counterparties and put up big trades, and that it's more volatile as a result. Is that also something you guys have encountered out there in this post-Volcker world? Chris, your thoughts on that, as well as in general the fluid regulatory environment we're looking at going forward?
Well, everybody on this call has been through this transition where liquidity came from floor market makers to proprietary bank desks to now what we call liquidity providers. So as we're certainly in tune and cognizant of the fact of where do we find liquidity, where do we get good prices for our customers and our clients. But that goes in hand with having good relationships with brokers, knowing where to find liquidity for the different types of things that we trade. At the end of the day, I think anything that's going to allow markets to be free is a good thing for our system. I also think people view risk differently. That's something that we have done a great job here of embedding into people's brains is how to manage their portfolios and protect and always be invested and always be hedged. So, if the Volcker Rule gets repealed, are we going to go back to the 2008, 2009 scenario where a lot of people didn't really understand the risks of their portfolio? I don't know. I think that would be a big topic for debate. But if that were the case and that was the scenario, we would be prepared for it under any type of circumstance. So, volatility, one aspect, liquidity, another aspect that we have to deal with. But we've been dealing with this for 19 years under all these different, I don't want to say the word, right, regimes of who is actually providing the liquidity. Someone's always going to provide the liquidity there. We may have to incentivize them. I think we've noticed some products out of the CBOE lately that they're just people aren't providing the liquidity yet. It's kind of like, who wants to be the first person to the party? But free markets are a good thing. There's a different understanding of risk out there today. And so, again, I think it'll be another challenge that everyone will have to deal with, and we'll deal with it like we always do.
Sounds like you don't have any preference then if Volcker gets reinstated or not. You're not welcoming back the flood of liquidity providers to make your job any easier.
Yeah, look, more liquidity is better. It's going to mean more prices, but is that really, really going to happen? I don't know after all these years if people are going to look at the markets and say, well, you know what, let's flip the switch and open the desks back up again. That's going to be something that we'll have to see.
Yeah, I'm kind of with Aash on this one. I was a little surprised to see all these CEOs so reluctant to jump back in, because that has been such a big profit center for them for so long. But yeah, if that holds course, then maybe we won't see as many people flocking back in, and maybe getting rid of Volcker won't be the sea change everyone initially thought it was. Speaking of the sea, you were down near the sea, Russell. Just came back from the big Inside ETFs Conference. And I know it seemed like everybody was down there. So I may have to go to this thing next year. It seems like it's a big event. And I know ETFs and ETF options in particular are so huge to pretty much all facets of the options audience these days, including, of course, the advisors, asset managers who are out there using SPY options predominantly, but also, of course, just every other flavor under the sun, GLD for their gold exposure, and just about everything else you could think of, USO for commodities, and VXX, of course, and everything else out there. So, Mr. Rhoads, you just got back. Give us a breakdown of this conference. What the heck is it? Who goes to it? What were they talking about? And what were some interesting things you heard down there?
Well, there were 2,200 people there.
Wow, that's a huge event.
It is a very huge event, and it's very social, which, I'm not very social, so I didn't really participate in that part. But, out of the 2,200 people, I think about 400 individuals like myself, either from an exchange or an ETF provider, and then just a slew of advisors looking for different ways to do things. And, this thing is only 10 years old. The conference has grown from 400 people to 2,200 people in a very short period of time. The area that everybody continues to kind of gravitate toward is the whole, somebody gave a presentation that said, and this is supposed to be sarcastic, smart beta is dead. 2017, the year smart beta died, or something along those lines, but he was actually being sarcastic, because they feel like that, the more active types of ETFs that are out there trying to generate alpha one way or another, that seemed to be what was generating the most interest. That and the interview with Alex Rodriguez were the two things that seemed to get the most interest.
The renowned ETF expert, Alex Rodriguez.
A-Rod, yep.
Was he saying sell VXX? What was he talking about up there?
He was not. And that was the thing. I'm glad you said that, because that was the thing that I found. I know that we talk a lot about volatility every Friday, but there was not a single session discussing the volatility-oriented exchange-traded notes or products. And you would just think that...
Well, CBOE clearly needs to sponsor a session next year to do that.
I guess maybe nobody wanted to sponsor.
Yeah, but it was, you're right. I looked it over after I know you were sending me a lot of information, and everyone on my Twitter and everyone else was hitting me up with photos and things from this Inside ETFs event. So might need to check it out next year. We don't usually we do some other stuff in January that's more local here, like the Chicago events and things like that. But you don't need an excuse, really a big one, to get down to Florida in January from Chicago. So maybe I'll check that one out. And certainly ETFs, a growing part of the landscape, and we're always considering adding more ETF options oriented content to the network, so maybe that'll fit in going forward. So there you go, listeners. If you need something to do next January, you use a lot of ETFs in your practice, and maybe the Inside ETFs event, maybe something you want to check out. Speaking of events you want to check out coming up, since we're on the topic of events, Russell, you guys over there at the CBOE have your own big event coming up, which I do believe Aash is actually speaking at as well. So why don't you give us an overview of what the heck the RMC conference is, where and when is it? Then I'll let Aash talk about what he's going to be talking about.
Well, the risk management, you're an infrequent attendee. You always go when it's in Florida. You've got
I go biannually.
Is there a warrant out for your arrest in California or something?
You know what it really is, quite frankly. This is inside baseball for the listeners, but there's a big industry conference in Florida at that time of every year in March. Okay. And so it's easy to do both when they're both in Florida. It's a pain. Sometimes they literally overlap on the days, and so I usually have to pick that one. But maybe I'll make an exception for you guys this year.
We always love to have you out there. So risk management, we go from coast to coast each year. This year is the California version, March 8th through March 10th. A lot of focus on derivative use and, of course, volatility instruments, because we are we're kind of we're almost more of a volatility exchange than an option exchange, depending on the day. The agenda just came out shortly before I ran down to Florida for the Inside ETF Conference. So I'm starting to pay a little bit more attention to it. The thing that and no offense to other speakers, but the thing that I'm a little excited about is Edward Thorpe, who is 84 years old. And if that name kind of rings a bell, he kind of was the original card counter, or came up with ways to get an edge in the blackjack world. Well, he's actually one of our morning keynote speakers, and he has a brand new book. 84 years old, and he's got a brand new book that came out a couple of days ago. And then, needless to say, we've got a wide variety of practitioners, which is what I think makes risk management such a great conference, because you have people that are willing to talk about what they do from day to day and give, probably not giving the whole secret sauce, but sharing insight with other individuals, which usually sparks some pretty interesting conversations as well.
Yeah, I do like going to that event whenever I can, and I was joking. I would like to go to it this year because it is a unique event. It's not just the same industry crowd that goes to it, or a retail crowd or anything like that. It's a very unique crowd. Usually people on the fund manager and the actual implementation side of the fence, which is kind of nice, kind of unique. You don't really get that at a lot of events, and they're up there, you're right, kind of peeling back the kimono a little bit and talking about, here's what I do, here's what's been effective. That's always been surprising me. People are willing to get up there and kind of talk about what they do. Like, of course, last year with the 1x2 VIX strategy that's been so popular, people detailing that. Of course, last year the theme of the conference almost seemed like it was everyone collectively rediscovering selling puts and the volatility benefits and the portfolio benefits of doing that. So who knows? Maybe there'll be an interesting theme this year as well. Speaking of which, Aash, I know you're speaking at the conference this year. What are you going to be talking about for Swan out there?
Well, first, that's 84 years old. That's tough to compete with. Some of the topics that we get feedback on, requests for, are back testing, specifically the use of big data these days and technology. And we're going to try to address some of the practical considerations, just more human nature concerns versus number crunching that you need to consider when evaluating back tests. And secondly, that the quest for yield continues, systemic option income strategies. So those are basically the two things we're addressing, and hopefully it'll be somewhat interesting.
I'll look forward to checking it out, and hopefully I'll make it out there so we can have some good coverage of the event for you guys on the network, listeners. And before we go, really, before we get out of the buzz segment, I do want to hit on a couple other things really quickly. Some people have sent us this article. Apparently it caused some umbrage out there. I just thought it was kind of funny. It was an article, I think it was on the street, and it was called Forget Dow 20,000, Consider These Hedges Instead. And a lot of listeners, particularly this program, took umbrage at the fact that this article talked about, there is a substantial chance for retracement under Trump in the next few years. And if you're worried about that, here's how you should hedge your portfolio. And they went on at length, listing 10 what they termed hedging strategies, including one, buying gold, buying silver, picking Trump-friendly sectors, including defense and construction and financial services, and a couple of other things. Nowhere in there, in this extensive list of items that they mention, do they ever mention any sort of direct hedge, which is buying some sort of put or put spread or doing anything along those lines of the strategies that we advocate time and again. It is kind of funny. Maybe this still kind of reveals some of the ignorance of the broad financial media when it comes to this kind of thing. It's there is one product out there that still offers a pretty much one-to-one direct hedge, and that's what you want. That gives it to you. These other things, their correlations are ephemeral, and they change depending on the market conditions. How many times have we heard, in the last few years when there's been a massive sell-offs, everything's moving in lockstep and correlation moves to one? Guess what? When you're doing that, your hedges in gold or silver or anything else don't really work that well. So it is kind of funny. This should at least be an addendum here somewhere. And I know maybe if all the listeners who wrote to us with this sent us this link, sent it to those folks, and the author, I don't have the author's name here, then they too, maybe next article, will do that. But this is kind of par for the course. It kind of just brought a smile on my face. But I thought if you guys had any thoughts, if you share the umbrage of our listeners, or if perhaps this is just more in the ongoing deluge against options on a regular basis. I don't know, Aash or Chris, do you guys take umbrage to this, or is this actually good for you guys? Maybe if people aren't out there singing the praises of options, it gives you guys room to do it yourselves.
Well, yeah, it definitely gives us some more room, and this all these hedges are coming from basic, classic modern portfolio theory. Now, you mentioned a great point about the correlations. They have dropped a little bit. It almost feels like a trading environment in a way, like we were used to back in the day. But as soon as the next financial shock, steep correction, bear market, whatever you want to call it, happens, I mean, we all know on this call that correlations are going to spike right back up towards 1. And anyone who thinks that they had protection, using all these different types of hedges, are going to go through the pain again and, learn it the hard way. So, I mean, what we do here at Swan, and we believe in hard correlation, hard hedges that are going to give us that absolute protection when we need it the most.
I'm glad you mentioned that, because that was kind of my first thought when I read that article as well. I was like, wow, this guy seemed like he just opened up his financial textbook 101 to the CAP-M model and just kind of wrote it down in this article, because that's kind of exactly what he's delineating there. Let's call it the old school way to hedging your portfolio. All right, we got a little bit of time left on the show. I want to make sure we get a lot of questions. I want to make sure you guys get your time here on the old program. So without further ado, let's keep on rolling into the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. Like the man said, this is the portion of the show where you guys get to dictate what we talk about with your many, many questions. We always have a backlog of questions on this show, so we like to get to as many as we can. Let's kick things off, actually, with a question we asked you guys. We like to ask questions to our audience every now and then. And ahead of this show, we asked you guys, what are you primarily looking for when buying an options-oriented fund? Whenever you do these polls in places like Twitter, you're limited to 4 options, so we were limited there as well. So we gave you 4 choices. We gave you levered returns, so your 2x, your 3x, that kind of thing. Income generation, and so hedging or protection, or we gave you a 4th option, say other. Tell us what you're looking for instead. It's only been up for not that long. It's kind of a flash poll we put out there. But that said, maybe Aash, we'll start with you. What do you think is winning the poll? Let's do that. What do you think is winning the poll? And I'll let each of you kind of weigh in on your thoughts, and then we'll give you what the actual answers are. So Aash, we'll start with you. What do you think is winning? What do you think our listeners out there? And again, this is our whole audience. This is the broad spectrum of everybody, not just the audience of this program. So what do you think they're looking for when they're picking up an options-oriented fund?
I would guess income generation, because the quest for yield continues.
I hear what you're saying there. Maybe Russell, what are your thoughts, sir? And are you offended? I didn't put some sort of volatility thing in there for you.
No, but income generation is really being short volatility. But I would agree with income generation. I had a couple of discussions along those lines when I was down in Florida at the Inside ETF Conference, because there is still a search for yield, and options are one of the few places I think you can get it these days.
The search for yield continues. Chris, is it a trifecta? Do you agree with your 2 cohorts here on the program, or are you going to go levered or hedge? You going to speak the Swan mantra and go hedge, or something else entirely?
Well, last time we all picked the same one and we were all wrong. So I'm going to have to change my answer. And especially with markets at all-time highs, I think the first thing for a portfolio for anybody is looking for hedge protection. And then throw a little yield in there.
We thought about doing a combo, because obviously, collars and what you guys do certainly speaks to both defensive and yield. But you're limited with your options there when you're doing these kind of polls. That said, I wasn't leaning your way, Chris, but I was thinking it would do a little bit better than it did. Turns out Russell and Aash were on the right track. 55% so far saying income generation. And number 2 with the bullet was levered returns of nearly 40%, looking for that 2x, 3x type of return, and only 6% a very meager 6%, Chris, coming for the hedging. I thought that would be a little bit higher too, because you think of the two primary use cases, you think of those, but apparently levered returns are where the action is as well. If you haven't voted, you got a few hours left. By the time this show is, I think, live, you won't. This poll will be done, but hopefully you have a chance to make it. Interesting stuff, nonetheless. Chris, does that surprise you at all that the hedge is only getting 6%?
Well, I was going to say that's a great contrary indicator. So it also shows that there's still a lot of people out there that need to revisit their portfolios and consider hedging and protecting some of their investments down the road.
There you go. I like it. Sees it as a contrary indicator. Yeah, that kind of surprised me that it was so one-sided in one direction. All right, let's move on. This one comes from Tim. It's too bad Mr. Tusaw couldn't join us today because this would be a good one for him to answer too. This comes from Tim Avery. He says, if I choose an advisor that uses options, do they traditionally charge higher fees than straight up equity advisors? That's the fee area is always an interesting one, a bit of a contentious one. It's a point of pain for a lot of clients and their advisors. Quite frankly, it's why we've seen such a push into the robo/automated side of the space. Because for a lot of what he terms straight up equity advisors in the question, a lot of what those guys are doing, they're not really bringing a lot to the table. They're doing your 60-40 or 60-30-10 if they're really aggressive, and that's kind of it. And that really isn't a lot of value. And then they're charging a lot of fees. They're giving you high load funds and things, and it's a very contentious thing. We actually talked about it when we had the John Oliver segment a few months ago, talking about that in this program, and just so many hidden fees that are wrapped up into that. That said, maybe Chris or Aash, if you want to chime in first on this one, what are your thoughts? What do you have to say here for Tim, who's looking for an advisor, kind of does what you guys do? How does that break down from a fee perspective usually?
Fees are definitely important, but it depends on the advisor and what kind of service are they giving you. Is it long term or short term? Are their interests in front of yours? As you know, Mark, we here at Swan, we're definitely in for the long term with our 19-year track record, and the only way we've been able to achieve that is by weathering all these different storms and making sure that we're putting our clients and our customers first, and making sure that they're getting the right protection. Even in like right now with the poll you just did, it doesn't seem like anybody seems to be interested, as far as that poll is concerned, with hedging and protection when the market is all-time highs, and that's really when you probably need it the most. But you don't realize it. So, again, fees, I think there's been downward pressure on fees. Everyone will probably agree with that on this call. So, I don't think fees are going to be the difference maker if you have a good advisor and who's preserving your capital for the long run.
Russell or Aash, anything on this before we move on to the next question? Need a little Jeopardy theme music in the background. Going once, going twice. All right, here we go. Next question is from Ashlyn or Ailing. These Gaelic names sometimes throw me, but she asks, what is it here? Oh yeah, seems as though, this is just what we were talking about earlier, Chris. Seems as though correlation is trending upward across asset classes. Do you find that this is a more favorable environment to trade options versus other assets? And what are your clients saying about this? So this kind of gets back to what we were just talking about. We've heard this lament quite a bit. In fact, when we first started the show a few years back, we were in one of those environments where the correlation was approaching one across a lot of different asset classes. And so we saw a lot of people coming to this program with that complaint and saying, hey, what can I do about it? And in that environment, it almost is a perfect sales or promotional environment for options, if you will. Kind of what I was saying earlier about, these other products, their correlations vary, and they're very much contextual and scenario dependent on what else is going on in the market, how much correlation they're actually going to have to the underlying and to the broad markets. And if that's your hedge, as that guy put it in that other article, if you're relying on that for your quote unquote hedge, you want that to be something standardized, something you can rely on. And that's the one thing options do. If you buy an S&P put, you have a lot of metrics right there of exactly what it is. You buy a 50 delta put, you know exactly what you get. Every point in the underlying, you can get 50 cents of protection. That delta is going to change based on the gamma. You have all that mapped out right in front of you, and it's a very standard and straightforward thing. And that's something that's not going to change. I mean, volatility will change. That will impact the options price and some of the other metrics there. But in general, that put is going to be there regardless of what the heck's going on with gold or anything else. So that's kind of one of the nice things. I don't know, Aash and Chris, you guys are always out there having to do this on a regular basis and kind of sing the praises of puts. First off, what do you have to say for Ashland's question about correlation impacting options? And then, do you think that has this made your? I mean, I know you guys aren't out there doing the day-to-day sales, but has it made kind of the conversation a little bit easier? Because I'd imagine people are more receptive to the options discussion in those kind of environments when their traditional hedges, like they mentioned in that article, aren't really maybe performing the way they expected.
Well, I think, things like gold and some of these other asset classes we're talking about are simply more manic in this correlation environment. I mean, it plays to what, our core belief that S&P options are, the best overall hedge for this environment. I guess the only thing I could say is, like, maybe if you were trying to increase returns, gold might have some value. If you've ever been to a Trump Tower, the whole thing's gold plated. Maybe he'll redecorate the White House the same way. But if you want to protect your portfolio, I think you can't go, much better than S&P options as correlations rise.
Russell may take umbrage at that and say a VIX call, but but that said, you're right. It is an interesting environment. I don't know, Russell or Chris, any thoughts on what Ashland/Ailing here is asking here?
I think SPX for the vast majority of individuals or advisors is probably the best way to go if you're trying to hedge against some downside. The only exception I would take to that is maybe if you've got more of a small cap focus, or you might want to consider RUT options instead of SPX options. We've seen some dramatic divergence in performance between the Russell 2000 and the S&P 500 since the election. And, the other thing is, if you have concentrated net worth, or, you're a guy down in Texas and everything you own is in the oil market, maybe you should be looking at industry ETFs instead of SPX. But I think, 9 times out of 10, SPX is going to win that argument.
Chris, any thoughts here for Ashland?
Yeah, I think one of the topics that needs to be discussed when you're talking about correlation is the change in correlation, i.e. the speed of that change. So you think, using CAPM, modern portfolio theory, that Aash mentioned the word manic. Well, manic to me was like, wow, these things can move very quickly, which means correlations can move very quickly. And what are the odds that someone out there is going to be able to reconfigure their portfolio in time to avoid correlations going to one, and then learning the hard way that they really don't have an adequate hedge on their portfolio?
All right, we got so many questions here, and we're running up against it. Let's see. I'm going to throw a dart out here and see if I can get another interesting one. How about this one here? This comes from Angelo Miles. He says, hello. Well, hello, Angelo. I found your program while searching for options information for RIAs. Let me just say, it was a refreshing breath of fresh air. Well, thank you. After the dense material available on other outlets and broker sites. It seems that most of them, and he includes a link here, I believe, to the Wells Fargo page, just say that options are risky and link to something called the characteristics and risks of standardized options. What is this omnipresent booklet, and why should I care? I tried looking at it a few times, and it just put me to sleep. Well, that's an interesting question, Angela. And you're right. That is kind of the surface attention that people pay, I should say, to options on a lot of these big firm sites, and a lot of them that really don't want to do a lot of options. It's kind of, that's their surface thing. And as it referred to what that book is, I think I have the booklet here around here, that the one that was handed to me when I walked onto the floor of the CBOE in 1997, that really hasn't changed a heck of a lot. Too bad our friends from OCC aren't here, because this is very much their bailiwick. That's their book. And what that is kind of, whenever the lawyers and the regulators get involved in the space, they have to have their standard series of disclaimers. And that's effectively what that book is. It's the standard disclaimer for the industry. Everyone says, hey, go read that book. But they know no one's going to do it. It's like the EULA at the end of the software you have to click to agree to in order to get access to whatever it is, the software, the game, whatever it is you're using. No one reads those either. And it's the same kind of thing. It's a massive booklet that really, you're right, if you do trudge through it, it does kind of put you to sleep. It's not really anything to do with trading. It more really just outlines, like it says, the risks of options, which is kind of, from a regulatory standpoint, all that they're really concerned about. You can access that everywhere. The link's on the OCC website if you want to get that too. But it's kind of just the standard, here's our disclaimer. And then once they've told you that, they're kind of covered from a legal perspective. But if you think you're going to read that and understand options, you're much better off listening to a program like this, going to educational stuff like Russell offers over there at the Options Institute, or the legion of free educational things out there like our friends at OCC have on their website. There's a lot more educational material than the old characteristics in Rick's book, which I haven't even changed the cover in like 2 decades. That book could probably use a bit of a refresh. That said, any of you guys have any thoughts here on Angelo's question before we move on to a couple others? Nope. The ODD, the characteristic in Rick's has even put you guys to sleep. All right, we'll move on to let's see. There's one. Here we go. This one from Adam. Right up your alley here, Chris. He says, could you please explain what it means to gamma scalp, he puts in quotes, and why this is not called delta scalping? Thanks, and your show has saved me a lot of money now that I've come to the dark side. He's blasting away a lot of premium around earnings, something similar to that. Gamma scalping, Chris, obviously a term we used to use a lot when we were on the floor trading. It was kind of the way a lot of guys either defended their positions or actually made their money while the rest of their positions were kind of just sitting around. Why don't you walk him through exactly what the heck gamma scalping is, and maybe why we don't call it delta scalping, even though that could potentially apply as well.
Yeah, no problem. So let's start by defining what delta is, right? Delta is going to be the change in option premium for a change in the underlying. So if you own calls, for example, and the underlying moves up, well, those are long deltas. If the underlying moves up, you get longer deltas. And so that change is what we refer to as gamma. Long options, I always say, have good gamma, meaning they're going to manufacture deltas in your favor. So if the market goes up, you're going to get longer deltas. That's a good thing. If the market goes down, you're going to get shorter deltas. That's a good thing. So the whole gamma scalping idea is to neutralize your portfolio or take advantage of the moves in the underlying to, if you're getting long delta on the upside, for example, sell out some of those deltas, neutralize your portfolio. And then if the market moves back down and manufactures short deltas, you get to buy shares or deltas, if you will. So that's where the term gamma scalping comes into play. It probably should be called delta scalping because that's what you're doing. You're just scalping your deltas. But, we refer to it as gamma scalping because it's gamma. Gamma is what is changing the delta, right? That's the second derivative. So, not quite sure why we always called it gamma scalping, but I guess it was just because, hey, it's gamma, which is what's producing the change in my deltas, and it was a good opportunity, to hedge out that kind of risk given a certain underlying movement, whether up or down.
Yeah, I think this question raises a good point. It kind of points out also this kind of the somewhat opaque and impenetrable nature of options terminology. We throw these terms around all the time because we're kind of just used to them. Makes perfect sense to us, but someone on the outside, maybe it should be called delta scalping, a little bit more straightforward of a term. But a good question. Good synopsis there, Chris. We think we've got time for one more here. How about a nice straightforward one here to wrap up? This one seems like it's right up your alley here, Aash. This comes from Yukoner. I like that handle. He, or perhaps she, says, are covered calls still a viable strategy in a 401k these days? We get a lot of questions along these lines, particularly in these types of environments, volatility trending lower. We talked earlier about the hunt for yield. It continues inexorably no matter what's going on in the marketplace. And inevitably, people, when using options, have that question. They always turn to covered calls. That said, Aash, what do you have to say here for Yukoner? Wants to know if he could still write his calls in his 401k or if that's just wasting time.
I wouldn't say it's wasting time. I'd say it's more effective in certain situations than others. Like as you said, with the markets at highs and volatility at a low, you're probably not getting as much for your calls as you normally would. One exception to this might be in single stocks, particularly going into earnings season. Volatility tends to bid up with uncertainty, and depending on your perspective or your view, that might be a good opportunity to sell covered calls to try to generate a bit of portfolio income.
Couldn't agree more. Russell or Chris, anything on this from our old friend Yukoner before we wrap up the office hours for today?
Nothing dramatic pops into my mind.
Even though you wrote that massive weighty tome on the option strategy, sir, nothing comes to mind? Okay, I'll allow it. That tome is so weighty, it's just, it must have hit you on the head before the show and just robbed you of all questions. Okay, that's all the time we have for the office hours. It's great questions. I love the way you guys just take us into all sorts of interesting and different directions. Of course, that music means that we have also come to the end of this epic sojourn through the world of advisors and options. Kick things off, of course, talking about the impact of the new regime, both from a political and a volatility standpoint, and how that may impact things going forward. We also talk about the evolving regulatory landscape and what a crazy and wild place that is these days. The boom area of our business is compliance. That's good if you're a lawyer or a compliance official, maybe not so good if you're in any other aspect of the business. Russell, of course, broke down the Inside ETFs Conference. Check that out if you are indeed so inclined to trade a lot of ETFs, as well as, of course, the upcoming RMC Conference that Aash will also be speaking at as well. Then we got a legion of your questions across all sorts of things, correlation and everything else. Keep those coming, by the way. If we didn't get a chance to get to your question, I apologize. Maybe we'll do a all questions episode one of these days because you guys hit us up with so many questions. But before we go, let's go around the horn again one last time and chat with everybody and see what they have coming up. I know Chris and Aash, you guys have a big event coming up pretty soon in your ongoing 10th Box series. In fact, if the little birdie on my shoulder is correct, I believe your next event is coming up in February 28th. Is that not correct, sirs?
That is correct. They were very well received last year, so we're going to do another round this year. We also have our second CIO conference is coming up, and it's going to be in Chicago, which I know you attended the last one here in Puerto Rico, Mark. So that's going to be April 3rd and 4th.
Oh, it's going to be in Chicago this year. Oh,
yes,
great.
Sir.
My commute will be far easier.
Yeah, you won't have to, the commute will be a lot shorter for you this time. And our director of research, Mike Wakefield, just put out a really good piece called Market Forecasts and the Value Predictions, and you can check that out on our website.
There you go. Check it out at Swan's website. And of course, if you want the actual 10th Box events as well, I believe they are just 10th Box. It's 10thbox.com, and that will take you right to the registration page for these 10th Box events if you are indeed so inclined. And, of course, the main site, if you want that, for all the content we talk about, they have a blog up there as well, their quarterly newsletter, swanglobalinvestments.com. And, of course, they couldn't make it. I think they were busy at the Inside ETFs Conference. You may have seen them down there, Eric and his team down there from OCC, Russell. But our friends over at OCC, check them out. I mentioned them earlier on the show. Optionseducation.org is the home for all of their great options educational content. And, of course, if you are an advisor, click on that advisor tab on the far right side of the homepage. You have to log in, but once you do that, they have access to a lot of great data and studies. They always come armed to this program with all sorts of great analysis, which we love to hear from them. And hopefully they'll be able to join us again on the program soon to break down some new great studies they have. They always have great stuff analyzing collars. So if you're sitting down with your clients and you're saying, well, how do I convince this person that they want to use options? They have the data that you might want to use in that conversation. And last but certainly not least, Mr. Rhoads, if our listeners are interested in getting their hands on your weighty tome on all things advisors and options, where should they go? What should they do, sir?
Amazon. You can find a book on Amazon. I've got a handful of books on Amazon, and the most recent one is the one that's more about geared more toward advisors and professional investors, and it's fairly brief because I instead of using technical jargon such as gamma scalping, I try to keep things very basic and stick with the kind of strategies that the majority of portfolio managers want to know about: cash secured puts, covered calls, and portfolio hedging. And that's why you can't hurt people with it when you try to hit them with it.
Check him out. Last name is Rhoads. If you're looking at how to spell that, you too can get access to his very, very small tome and all the rest he's written over there on Amazon. On behalf of Russell and Aash and Chris and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for sending in such great questions. Keep them coming, and we'll see you next time for more of The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.